Greetings, my YouTube family. Thank you so much for visiting my YouTube channel. So, today I would like to talk about the 7 most common mistakes that most retail investors make in the stock market. But before we get started, I would like to encourage you to please click subscribe so that you don't miss content like this in the future. And also, that the educational content in this channel is not meant for investment advice. So, please always consult your investment advisor. So let's get started. Over the past 3 or 4 years, I have been closely monitoring the Canadian and United States exchanges. So here are the most 7 common mistakes that I noted, even also from chatting with other retail or individual investors who invest in those stock exchanges. The first one is that a lot of retail investors, they get started in the investment before they build an emergency fund. So an emergency fund is basically go-to fund. Let's say if you lose your job unexpectedly, and you can sort of take care of your living expenses. So it is very very important to make sure that you build at least a 6 to 12 months worth of emergency fund. For example, if your living expenses are worth 1,000 per month, so you can have up to 6,000 to 12,000. That is just sitting in a cash account. That is, it is ready if you need it. Let's say your child falls sick. So it's very very important. The advantage of having an emergency fund is that in the stock market, what happens is that usually the stock market doesn't go in the straight line. Sometimes it goes up and down. In most cases, you find that historically the United States Stock Exchange over the past decades, it has been going in some periods of bear markets. In other words, the major indices like the S&P 500, they drop by at least 20%. So when that happens, it means if you don't have enough money to take care of yourself, let's say in case you lose your job, it means you would be forced to liquidate your position. In other words, to sell your stocks at the bottom, thereby losing money. So if you have an emergency fund and you have some extra cash that is on the sideline, you can then actually, after you do your research and due diligence, when the stock market drops at that level, it basically means if you understand your valuation, you can take advantage of the huge discounts in the stock market. Because what happens, most people they panic when there is that drop in the stock market because they don't know. They think like, oh, maybe it's just going to continue falling and falling, and it can do so for some extended times, even for a year, right? So what it means is that if you need cash, you would be forced to liquidate. But if you actually had some money that is on the side, you can actually take advantage of that opportunity, because you can then buy those quality businesses at a huge discount. So I cannot understate the importance of having an emergency fund. Secondly, a lot of people assume that you need a lot of money to get started in the stock market. I started investing in the Canadian and US stock exchanges with $300. I know some brokers, they have a minimum balance, let's say $1,000. So you can get started. They say money in the market is better than money outside of the market, because a lot of people, they wait for far too long, waiting for the perfect moment and to have the perfect amount. So sometimes after you understand where you want to invest your money, it's good to get started. Thirdly, it is important to have proper education. For me, I'm lucky that I have a background in economics and I love reading. A lot of information is publicly available. For example, if you want to analyze the stocks, the financial statements, it's available even on the company's website, and even the regulated authorities. For example, if you are investing in the United States Exchange, there's the Securities Exchange Commission. So every other publicly listed company that trades in the stock exchanges is supposed to publicly list or to file that information if there are changes in their shareholding or in the business that can affect or change the risk structure of potential investors. So it is very very important to educate yourself. Sometimes people enroll on online courses, and that can be another form of education. Number four, a lot of people, they ignore history. I have been studying the stock market and I continue to do so. But what I've noted that historically every other 4 years there has been at least a bear market, or that is a 20% drop in the major stock exchanges, and or at times even market correction, that is a 10% drop. But sometimes it can go up for extended times, maybe for some couple of years. So it is very important to learn from those mistakes, because what people do sometimes is they just panic, and when they panic, they sell at the bottom, and thereby losing instead of making money. Then number 5, understanding the tax code in Canada and the United States, where I mostly follow the capital markets. Their tax codes. It's very important that you consult your tax advisor so that you can optimize on your investments. And also, even it is also a good idea to understand the tax structures so that you can understand which is the best account to invest. For example, in Canada, there are various accounts: tax-free savings account, registered retirement account, each with their own tax advantages and disadvantages. So once you understand that, it can be helpful. And then the last but not least, the seventh most common mistake is that a lot of people, they think investing is a get rich quick scheme. It is very, very important that you are patient. There are sometimes when it's just worthwhile to just be an observer, to note and understand what is happening in the market, and just do nothing other than understanding the businesses and not doing anything. Sometimes people, they pay a lot of fees by just buying and selling and panicking. So if you understand the importance of patience and waiting, right, for the best time to invest in the market, then you can save money from fees, but also you can take advantage of the huge up and down swings in the stock market. For example, this year, Meta, when they announced their earnings and that they also wanted to venture into the artificial intelligence in terms of their business, the stock market, their stocks, it dropped by at least 40%, right? So what then happened is that a lot of people, they panicked. But when you closely look at Meta, commonly formerly known as Facebook, their fundamentals were just fine. The return on equity, they had some money that was set aside for research and development. You look at their cash flows, right? You look at their finances, and you look at their long-term debt. All those things, they were just fine. But the sentiment was that the company was going in the wrong direction. But thanks to good management, the company, they then corrected that, and then they changed course. And what happened is that this year it has been one of the top performing stocks in the Nasdaq, in the sense that it has come up, back up, and a lot of people who invested or who took advantage of that, they have made a lot of money. So that's it for today. And of course, there are a lot of other mistakes that some retail investors or even investors alike make, but I thought I would just share these 7 most common uh, mistakes. So thank you so much again, and please don't forget to subscribe below for more quality content like this.